Okay, well, let's get started. Thanks everyone for joining us. Today is March 20th of 2020, and for many of us, this marks the end of the first week of working at home or working in a different situation than we've had before. It seems like it's been quite a while, but it was just last Saturday and Sunday that it seems like things changed quite a bit in the United States in terms of the level of seriousness that we are taking things like social distancing and counting the numbers of people in our gatherings as we thought about what we were going to do in the coming week. One of the things that came up over the last week in terms of viewing what's happening in markets and around the economy, in addition to what's going on with the health news, is there is just some wonder about, hey, what's going on in the bond market? In normal times, when the stock market's declining, the bond market tends to go up. And starting about March 9th, we saw some activity where it seemed like the bond market was doing something a little bit different. It wasn't just going up whenever the stock market was going down. And people were asking the question, so, hey, why is that? So I wanted to look back a little bit. And we'll look at this chart here first. This is the great financial crisis starting back in September of 2007. And then I just ran the chart through June of 2009. And what you're seeing on this chart really is a bunch of different measures of the market. The gray line, the one that goes down the farthest, is the S&P 500 index of the U.S. stock market. And the other colored lines are different kinds of bonds and bond markets in the United States. There's intermediate government bond. You can kind of see the labels there on the right-hand side. There's a measure called the aggregate bond index, which is pretty much a careful measure of all different kinds of bonds traded in the United States, investment grade bonds. Then there's a short-term U.S. government bond index. Those are bonds with a 3 years or under duration, so relatively short. And then I put in there the Barclays Municipal Bond Index, because municipals have had some particular stress this week, it seems, over the last 10 days or so. Same thing with the U.S. Corporate Bond Index. And if we look back at this period of time in 2007 to 2009, what you'll see is over the period of decline in the U.S. stock market, bonds, for the most part, provided stability and some positive return, though it wasn't always without some declines along the way. But overall, if you were a bond investor in these times, you kind of got what you were expecting. You were looking for diversification. The stock market's going down. I need another part of my portfolio that's going to maybe protect or preserve some assets, and that's what's happening when we looked at those. The thing I want to look at more carefully, though, is this area right here. We'll kind of go ahead. And what you see is at times when the stock market is under extreme pressure, something happens sometimes, even if it's just for a short time, where stocks and bonds begin to behave kind of in a similar way. This is something we wish didn't happen, because we'd really like it when the stock market's going down for bonds to always be going up. But corporate bonds and municipal bonds especially have some credit qualities about them that make them particularly subject to stress when the stock market's under it. Sometimes corporate bonds and municipal bonds will come under stress at the same time, because if the economy as a whole is going to suffer, there's some worry that corporations, not only is their stock price going down, but there's some concern whether they're going to repay their debts in terms of their corporate bonds. There's also some concern in the economy about whether municipal governments are going to have the tax revenues necessary to meet the obligations on their bonds. So what you see here is back in 2008, kind of at the time when the stock market was declining the most precipitously, that pressure on the bond market came, and we saw this kind of activity where bonds began to decline at the same time stocks did, even though over the rest of the period, they recovered. So let's look at what's happened here this week. This is from the Wall Street Journal earlier today, actually. And what I was looking at here was those same indexes, if you will, of municipal bonds, corporate bonds, the aggregate bond market, and treasuries, kind of short-term treasuries. And right up here, this top one, this kind of purple line, that's the one representing short-term U.S. government. So it's doing exactly what you'd expect. It's just holding its own. It's the highest credit quality bond in the world, and people tend to not trade that thing off. Everything else, kind of in association with this pressure in the stock market that we've seen occurring, everything else, these bonds starting on March 9th, they started to trade with some pressure and drift down. This is kind of troubling, because what happens is things get dislocated where instead of interest rates going down and bond prices going up, which is normally what happens when the stock market goes down, the stock market was going down and interest rates were actually rising, causing bond prices to go down. And the reason, the reason that's offered most regularly for that kind of a situation is because what happens in times of great stress or fear is people just want cash. So whereas before, if people were leaving the stock market and looking to buy a bond, thinking that was a risk-off asset, a more of a safe asset, when things get really tough, they go, I don't want to own anything other than cash. And so what happens with the bond market is the demand for certain kinds of bonds starts to dry up, which means that there's selling pressure, and so the prices of those bonds fall, which is exactly the opposite of what happens in the normal operation of the bond market when the stock market is declining in a more normal kind of a way. So we had an email conversation with Vanguard earlier this week, and one of the things that they were talking about, and you can see that they're doing the same thing we're doing. They're looking back at 2008 and saying, well, is this something that we've seen before? How abnormal or how concerned should we be about this? And what you'll see here in this first bullet is, yep, credit spreads. What that means is that return on corporate debt, the interest rates on those corporates are going up, meaning people are not willing to buy them at lower rates, so the prices are falling. And what they're saying is the spread between those corporate bonds and U.S. government bonds had widened across all these credit sectors, but it still was only about halfway as wide as the levels experienced in 2008. So we weren't yet to the stress level that we saw in 2008. The other thing they noted was just this kind of bullet here, reflection of a scramble for liquidity, specifically for cash. So again, if people are trying to get out of the stock market and they don't want to buy bonds, which is a more normal behavior, but they really just want cash because they're fearful, then that means there's no demand in the bond market, there's lesser demand in the stock market, and prices for both tend to fall. The last couple of things I'd note is that they did note here that the Fed actions on Sunday should help ease some of these liquidity concerns. And they're talking about last Sunday. Just last night, the Fed actually added corporate bonds and municipal bonds to their list of bond markets that they're going to enter in and support. That just means the Fed is actually going to buy bonds. So if there's not a strong enough demand in public markets for those bonds, the Fed will step in and they'll start to buy some of those bonds to support those prices. And what's interesting, at the end of the day today, and the market was going down pretty precipitously at the end of the day, the stock market anyway, is interest rates were back to doing what you would expect. As the stock market was falling, interest rates were falling as well, which meant that bond prices were rising. And that's actually a sign of health in the bond market. What that means is as people are selling stocks, the demand for bonds is there, whether it's by the Fed or by individuals or institutions, whatever it is, there's enough demand for those bonds that the interest rates are dropping and the prices for the bonds are actually going up, which is exactly what we want in our portfolios because that provides the diversification benefit. The last bullet here that I note from Vanguard is they talk about bond market or credit market conditions being fragile but functional. That makes sense given the pressure that we're seeing in the bond market and the stock market today. People are very uncertain about what's going to happen. So things are operating. There's buyers and there's sellers in the markets for both stocks and bonds. But in that bond market, it can be a little fragile because sometimes there's just not the demand there for certain kinds of bonds, which can cause bond prices to fall. At times you wouldn't necessarily expect that to happen. But I like that fragile but functional. I think that's something to kind of hang on to as a positive. And with the Fed action yesterday and as going into today, I think they actually restored a little bit more healthy functioning to bond markets is what we saw at the end of the trading day today on Friday. So how long might this last? And what's going on here? This is, again, going back to look at 2007, 2008. I'm sorry, my picture here is covering up the dates. I'll just move that. But you can see this time period, again, the same time period as when we were looking at before, that pressure on stock markets. And then we saw bonds declining at the same time. So over here, the S&P 500, you can see pretty bad couple months in September and October of 2008. Those are big numbers, right? Big negative numbers. And what you saw is kind of what you're seeing today, municipal bonds under pressure, their prices going down. Corporate bonds under pressure, their prices going down. The bond market as a whole kind of behaving differently than we normally expect in markets like this, but government bonds holding up the best. There's those intermediate government bonds showing positive returns, and the same thing with the short-term bonds. So exactly what we saw in the last 2 weeks, where we saw municipals, corporates, the bond market generally experiencing some pressure, governments holding up well as the stock market really went down pretty strongly. The other side of that is when things start to recover, and this is kind of coming out of that 2009 recovery. So March 9th coincidentally was the recovery date when things turned back in 2009. But if we look at returns in April, May, and June, what you see is the relationship with bond returns and the stock market kind of turned again, right? So the bond market begins to show positive returns. Over here, we see the stock market showing positive returns. And the one place that you see negative returns in the bond market is right here, intermediate government bonds. And what's going on there? Government bonds have been kind of unusually high during these periods of stock market stress. And once the market relaxes a little bit, I think things are going to recover. Then they expect interest rates are going to start to rise. And if interest rates rise, those government bonds that have been kind of going up in price, they're going to start to go down in price. So it's actually a sign of kind of economic and market health on the stock market side when you see kind of this normal stress on government bonds. But again, if you look across the period, what you see is, again, go to this chart, through the entire period of the great financial crisis from 2007 to 2009, there were times of pressure right out here in bond markets, but overall, people who are diversified between stocks and bonds, they did see their bonds provide balance and diversification. That's what we want in the portfolio, and that's what we would expect to happen over time. One of the things, or a couple of things that I would just say kind of in closing here is, successful investors need at least a couple things. They really need to have a good plan for their portfolio, and they also need to have some patience. I don't know about you, but this week has felt like a very long week. It's only been, I've got a counter in my journal. I'm calling this day 6 because Saturday and Sunday last weekend seemed like the day when things really changed in terms of the way lifestyles change in the United States. But it feels like a long time. It feels like this has been going on for a long time and too long. If you look down here, what you'll see is this period of time was measured in months. We're kind of in the point now where we're measuring a little bit in days. Think about the US stock market was at its all-time high on February 19th, just a little over 1 month ago. So we're just kind of into a period of real pressure, and it's been intense pressure and very quick. But the thing that I would caution people, and I'm cautioning myself, talking to myself as well, is good investors are patient investors. These kind of relationships sometimes do get dislocated, the kind of bond market dislocation that we've seen in the last couple of weeks. But generally over long periods of time, even in periods of great stress like the great financial crisis, those relationships tend to come back to normal for people who are patient with their holdings. So at Foster Group, we're going to try to be really patient with our holdings. We understand that this feels like a lot of pressure and it's very uncomfortable and there's a lot of stress. And the stress of this financial crisis is really different than the one back in 08, 09, because we're talking about personal health. I mean, it's physical health as opposed to just financial health. Financial health was a strain in itself, but when you put physical health and fears on top of these financial fears that we have and anxieties, it's perfectly normal to think that we're going to feel very anxious and we want this to end as fast as we can. Everybody does. I know scientists are working very hard to find things that will help us through the health crisis. The Fed, the government, all those people are doing all that they can to support the economy through what hopefully is a short-term kind of event here that in, 4, 5, 6 months, maybe we start to see things turn around. It's hard to say for sure. But at the same time, patience is key to being a successful investor. We think that's still the case. We'll try to remain patient. If you have any questions or feel like you need to talk to your Foster Group advisor, we just welcome your questions. Love to have you give us a call. We're going to try to do these things every Friday on a different subject. So if you have suggestions for a topic that you'd like us to address, email that to us as well. And with that, we'll sign off for this week. And we hope you have a safe weekend, and we'll talk to you again soon.